Banks have been a cornerstone of civilization for thousands of years. The first recorded bank dates back to around 2000 BCE in Assyria and Babylonia, where people entrusted their wealth to temple priests for safekeeping. Fast forward to today, and there are over 40,000 commercial banks worldwide, handling trillions of dollars every single day. From managing savings accounts to issuing loans, banks are a pillar of modern community. But here's the catch. While you think they're working for you, they're really working for themselves. Banks have secrets, and once you uncover them, you'll never look at your finances the same way again. Let's start with the biggest misconception. Banks don't store your money, they use it. When you deposit money into your account, you might think it's safely tucked away, waiting for you to withdraw it. But that's not how it works. Banks operate on a system called fractional reserve banking, meaning they're only required to keep a fraction of your deposits as reserves. The rest of your money? It's being loaned out, invested, and multiplied. Here's how it works. Let's say you deposit $10,000 into your bank account. The bank might keep $1,000 as a reserve and lend out the remaining $9,000 to someone else. That person might use the loan to buy a car, and the car seller deposits the payment back into the bank. Now, the same $10,000 exists in two accounts. This cycle repeats, creating a ripple effect where your single deposit can fuel $100,000 or more in loans. While this system drives economic growth, it also makes banks highly vulnerable. If too many people try to withdraw their money at the same time, a phenomenon known as a bank run, the entire system collapses. And we've seen this happen before. During the 2008 financial crisis, panic spread like wildfire. Banks didn't have enough cash on hand to meet withdrawal demands, exposing just how fragile the system really was. Governments had to step in with massive bailouts to prevent the economy from completely crumbling. But here's the uncomfortable truth. The system hasn't fundamentally changed. Banks still operate on the same principles of fractional reserves, relying on the assumption that not everyone will withdraw their money at once. It's a house of cards, and banks would prefer you didn't think too much about it. But fractional reserve banking isn't the only secret banks don't want you to know. Let's talk about credit cards, one of the most profitable products they offer. Credit cards are marketed as tools of convenience and financial freedom, but they're actually designed to keep you in debt. Studies show that people spend more when using credit cards compared to cash. It's psychological. Swiping a card feels less real than handing over physical money. Banks capitalize on this tendency, encouraging you to overspend while they collect interest on your unpaid balances. And that interest? It's astronomical. The average credit card APR is around 20%, far higher than the historical return of the stock market, which averages about 8% annually. While they offer you rewards and cashback perks to lure you in, the truth is banks profit far more from interest and fees. If you're one of the disciplined few who pays off their balance every month, banks might even reduce your credit limit or stop offering lucrative promotions. Why? Because you're not profitable to them. Now let's talk about savings accounts, the so-called safe haven for your money. Banks love to market savings accounts as a secure way to grow your wealth, but the reality is far from it. The average savings account interest rate is below 1%, while inflation typically averages 2 to 3% annually. This means your money is actually losing value over time. Meanwhile, banks are using your deposits to issue loans at much higher interest rates, mortgages at 5%, personal loans at 8%, and credit cards at 20%. You're essentially giving the bank a free loan to make money off your hard-earned cash while they give you crumbs in return. And then there are the fees, the silent money drain that banks rely on to boost their profits. Overdraft fees, ATM fees, account maintenance fees, wire transfer fees, the list goes on. Overdraft fees alone account for billions in revenue for banks every year. The average overdraft fee is around $35 per transaction, and some banks will charge you multiple times in a single day if you're not careful. Even something as simple as requesting a paper statement can come with a fee. These charges might seem small, but they add up quickly, quietly eroding your wealth while boosting the bank's bottom line. But here's the real kicker. Banks are not just financial institutions, they're data powerhouses. Every transaction you make, every loan you apply for, every paycheck you deposit, all of this data is collected, analyzed, and often sold. Banks know your spending habits, your income patterns, and even your financial vulnerabilities. They use this information to tailor products and offers that maximize their profits. For example, if you consistently carry a balance on your credit card, they might offer you a personal loan at a low interest rate to consolidate your debt, locking you into another revenue stream for them. And it doesn't stop there. Banks also sell your data to third parties like advertisers, insurers, and retailers. This is why you often see targeted ads that seem eerily specific. They're based on insights banks have gathered about you. To banks, you're not just a customer, you're a product. Now let's dive into loans, the bread and butter of the banking industry. Whether it's a mortgage, auto loan, or personal loan, banks position loans as tools to help you achieve your dreams. But the reality is, loans are structured to make you pay far more than you realize. Take a 30-year mortgage, for example. On a $300,000 loan at a 6% interest rate, you could end up paying nearly $650,000 by the time the loan is fully repaid. That's more than double the purchase price of your home. And if you think paying off your loan early will save you money, think again. Many loans come with prepayment penalties, discouraging you from cutting into the bank's long-term profits. It's a classic heads they win, tails you lose situation. So, how do you beat the banks at their own game? The first step is awareness. Once you understand how banks operate, you can make smarter financial decisions. Instead of letting your money sit idle in a low-interest savings account, consider alternatives like high-yield savings accounts, CDs, or low-risk investments. These options can help your money grow at a pace that at least keeps up with inflation. Pay off your credit card balance in full every month to avoid paying sky-high interest. Set up automatic payments to ensure you never miss a due date, which can save you from late fees and penalties. If you're applying for a loan, shop around for the best terms and read the fine print carefully to avoid hidden fees and prepayment penalties. It's also crucial to protect your data. Use budgeting apps that prioritize privacy and opt out of data sharing agreements whenever possible. Banks thrive on knowing everything about you. Take control by limiting what you share. Lastly, consider diversifying where you keep your money. Look into credit unions or fintech banks, which often offer better rates and lower fees than traditional banks. The goal isn't to ditch banks altogether, but to ensure your money works for you, not just for them. By staying informed, vigilant, and proactive, you can turn the tables and take control of your financial future. If this video opened your eyes to the realities of the banking system, don't forget to hit the like button and subscribe for more insights into the world of money and finance. And let us know in the comments, what's the biggest banking secret you've uncovered? Thanks for watching, and we'll see you in the next video.